What does it mean to be fully insured? Hi, it's Dave Dickinson with Bankers Compliance Consulting. When it comes to any type of insurance, hazard, flood, etc., we need to be within 80% of the value at the time of loss to be considered to be fully insured. If you own your home, you probably have a rider on your hazard insurance that keeps it up with the cost of inflation. And so every year you get this adjustment rider. So maybe originally your home cost $100,000, next year they're going to pay out $105,000, and they just keep it going up and up and up, so that it keeps up with the price of lumber and shingles and bricks if there was a tornado or fire or something that took out your dwelling. When it comes to flood insurance, though, we buy flood insurance one time before we make the loan, and it never gets adjusted. Now, one of the rules of flood insurance is that you don't have to have full replacement costs. You have to have the lesser of three, the lesser of the loan amount, the insurable value, or the maximum they can buy under the National Flood Insurance Program. And so it's not uncommon to see cases where you aren't fully insured. You're not within 80%. Let me explain this to you in an example here. Let's imagine that we have a $100,000 structure and I own it free and clear, or I'm just needing to borrow $50,000 because I have enough or whatever. But the idea is that I'm borrowing $50,000. The dwelling policy limits for the NFIP, $250,000, insurable value $100,000, loan amount $50,000, so you go with lesser of 3. We check the box that we've met the requirement to get the right amount of flood insurance to meet the compliance requirements of this. But we're at 50% of insurance to value. We're not fully insured. Well, when it comes to a dwelling policy, if you're not within 80%, then they're not going to pay replacement costs. They're going to pay a percentage base. So let's imagine that we have $30,000 worth of damage, and that insurance is going to pay what? Well, you had 50% coverage, so they're going to give you 50% of the damage less the deductible. In this case, $15,000 minus the deductible. Maybe that deductible is $1,000 or $5,000. So the question is, can your borrower withstand that loss? Are they going to have another $15,000 plus $1,000 deductible or more? Or are they going to say, come take your collateral? This is something you need to be concerned about and understand. Now, this is really an area of expertise for the insurance agents to help your borrowers understand this, but you need to be looking out for this from a prudency standpoint. And I hope that this helps you do just that. Thanks for watching.